If I told you that XRP is about to leave platforms, it could cause one of the biggest supply shocks in the history of finance, would you believe me? We're not talking about a guess or a chance idea. There are real things happening now that remind me of times in the past when markets went through the roof. This is the kind of storm you get ready for if you've been waiting for a once-in-a-lifetime chance. What's going to happen next will catch a lot of people by surprise, and those who aren't ready will have to watch history being made from the sides. This is not advice about money. This is so crazy right now because of this. The Federal Reserve is about to lower interest rates, but the S&P 500 is setting a new record high. That doesn't happen very often. This setup has happened so few times that you could count them on one hand. In the late 1920s, just before the Great Depression in 1965, right before a huge burst of inflation, and in 1999, at the height of the dot-com boom, every time it caused market shocks that no one thought were possible. Now we're back together again. This time, though, there's a new part of the puzzle: digital things. There's more to XRP than meets the eye. Global financial companies are getting ready to add this piece to their systems. And when supply meets demand through ETFs worth trillions of dollars, you don't just get a rise, you get a supply shock that changes the charts. Also, let me say this quickly before we go any further. When the Fed cuts rates for the first time since 2025, they say it's because the job market is getting weaker. Since 1996, this is only the third time that the Fed has lowered rates while stock prices are at all-time highs. Take a moment to think about that. Prices have already gone above what they were during the dot-com bubble. We are no longer in the extremes of 1929, just before the Great Depression. But Wall Street says this is okay because we're going through the biggest change in technology in 20 years. AI on one side and Bitcoin on the other. But here's the catch. The Federal Reserve usually lowers interest rates when markets are weak and stock prices are well below their all-time highs. The Fed is going the other way this time. Even though GDP is still growing at about 3% a year and core inflation is still very high at 3.1%, they are cutting rates. But unemployment is going up, which makes them do something. The job market is getting worse. The number of Americans who say there are plenty of jobs has dropped to its lowest level since 2021. This is why the Fed is doing something. But it's like putting oil on a fire. It doesn't calm the markets down. It's the 24th new high for the S&P 500 in 2024. It's up more than 35% since April, when it was at its lowest point. That's before the rate cuts even start. You get parabolic moves when you add liquidity to a market that is already having a good time. And if that wasn't enough, companies like Fidelity, BlackRock, Grayscale, and Canary Capital have also started offering altcoin ETFs, some of which include XRP. These are big names in the game. These people are in charge of trillions of dollars worth of assets and have access to more money than most people can believe. In a way that crypto has never seen before, a huge amount of cash flows in when they let institutional demand in. Remember how things were when Bitcoin ETFs first came out? At first, it looked like uptake would be slow, but then the snowball effect happened, and as institutions started allocating more Bitcoin, the price went through the roof. Imagine that XRP and other altcoins are going through the same thing, but the Fed is cutting rates at the same time, and the stock market is already on a wild ride. That's not just positive. That's what it takes for a supply shock like we've never seen in crypto before. XRP also has a past to back it up. Prices for XRP went from less than 0.20 to over 338 in 2017. On some markets, they even hit a high point around 370. It went up 1,600% or 16 times because people were afraid of missing out. Early bank pilots were trying Ripple's cross-border tech, and the ICO boom was all over the place. After all these years, the scene looks eerily familiar now. The causes are much bigger this time, though. Bank tests are not what we're talking about. We're talking about adoption on a large scale. The amount of ODL that is changing is $1.3 trillion. For example, some ETFs need companies to buy XRP from exchanges in order to back their holdings. Also, the cash crunch gets very real very quickly when exchange reserves drop by more than 5%. Now, things really start to get interesting. Already, analysts think that XRP could go up to $6 in the next few days as these factors come together. But that's only the surface, because in the middle term, the race to get supplies could be like the 2017 boom. This could cause XRP to reach double digits, with $20 being a reasonable goal if rate cuts continue until the end of the year and institutional FOMO kicks in full force. Don't forget that during the election supercycle, XRP went from $0.50 to over $3 in just a few weeks. those conditions were just a sneak peek. Things that are coming together could be even bigger. One thing about supply spikes is that they don't let you know they're coming. When they happen, everyone is shocked, and the move is already well underway by the time most people understand what's going on. That's why getting ready is important now. The same thing happens whether it's big investors rushing to buy ETFs or small investors finally listening to their friends and family who say, I should have bought XRP earlier. There is a lot of demand, but less availability on the exchanges. That mismatch is what makes prices move in an exponential way. Also, let's be clear, all of this is happening very quickly. With this month's ETF deadlines, the Fed cutting rates, and institutions having trillions of dollars in extra cash ready to spend, XRP market reserves are already going down. Now is the time for the perfect storm to happen. Let's say you're an ETF seller. It's now okay for you to start an XRP ETF. Your customers want to be seen. To give that exposure, you can only buy XRP directly from people rather than through platforms or over-the-counter OTC deals. But if the float on exchanges is running out, you and every other institution are all trying to get the same small amount of stock. That's when the cost goes up. Those are the times when the charts start showing candles that no one's seen coming. Then things go back to the way they were in a way that shocks most buyers. That's why we're not just thinking about a possible short-term rise. In this case, XRP becomes one of the most important stories in world banking in 2025. Rate cuts start the fire, ETFs make it faster, banks light the match, and regular people give it oxygen. That's how a full-blown supply shock is made. This is what most people don't see when they talk about the next step. The price chart is all they can see. They are looking at candles, making lines, and waiting for breakouts to try to figure out if XRP will go through the same cycles it has in the past, but they don't ask the more important question: how has this market changed since 2017? How has it changed since 2021? What about last year's election supercycle? That question tells you everything you need to know about why the next supply shock might be bigger than any other one we've seen. In 2017, the crypto market was driven by regular people. There were no big companies that bought billions of dollars worth of tokens. There were not any ETFs backed by the world's largest asset managers. There wasn't a lot of liquidity, spreads were big, and exchanges weren't even close to being as efficient as they are now. The price of XRP went from $0.20 to over $3 because people were feeling greedy and scared, panicking and buying in large amounts, and fear of missing out, FOMO, hit full force. That was enough to send it 16 times in just a few months. Things are different now in 2025. No changes were made to the original sentence as it does not require any editing. Positioning tools from BlackRock, Fidelity, and Grayscale will bring institutional capital straight into XRP. These groups don't mess around with a few $1 million here and there. When they give out based on scale, a few $100 million or billions at a time. When there is that much desire, the price doesn't just go up slowly. It takes a lot of stock off the market at once, which has effects that can be felt on every exchange in the world. Take a moment to think about how this works mechanically. The person who issues the ETF has to go out and buy the asset as soon as it goes public. They need to buy the base to go with the shares they're selling to the public. So if regular people, financial advisors, pension funds, or hedge funds want to invest in XRP through an ETF, the provider has to make sure there is enough XRP. The trouble is that there is no central supply to tap into like there is with stocks. The government is not releasing any more XRP shares. You can only get a certain amount, and the only thing that is available in real time is what is on platforms. That's where the supply shock comes in. In the first few weeks after the market opens, let's say that a few $1 billion worth of capital chooses to move into XRP ETFs. So producers have to quickly grab any tokens that are available. As exchange reserves go down, prices go up for retail users. This starts the second wave, which is fear of missing out. All of a sudden, millions of new buyers rush in, eager to get a piece before the price goes up. Early investors who have been building up for years don't want to sell, though, because they think bigger gains are still to come. That failure to sell cuts supply even more. There is a feedback process where demand goes up and supply stays the same. In 2017, we saw that very thing. This time, though, organizations are making it happen faster. On top of that, let's add the macro world. If a stock is risky, rate cuts are one of the best things that can happen to it. More cheap money is coming into markets. It costs less to borrow money. Liquidity grows. Every dollar that wants to make money looks at crypto as a choice all of a sudden. It's not a surprise that during the dot-com boom, tech stocks went through the roof thanks to loose monetary policy, and it's not a mistake that Bitcoin went through the roof when interest rates dropped in the early 2020s. We are now going back to that same place. This time, though, it's happening at the same time as the start of altcoin ETFs. That's not just positive. That is historical. The information on exchange funds is one of the best signs that we're already in this phase. Analysts who keep an eye on XRP flows have confirmed that exchange-held tokens have dropped by more than 5% lately. On paper, that might not sound like a lot, but in real life, it's huge. A 5% drop in float can mean that billions of dollars worth of value are taken out of circulation. It's the same as squeezing both ends of a balloon. The middle finally bursts. Let's talk about how the market thinks and feels. Because people still act in markets, it doesn't matter how big the organizations are. Regular people who spend money are seeing this happen right now. While the election was going on, they saw XRP go from $0.50 to over $3 in just a few weeks. They know about the 1,600% rise in 2017. They're also beginning to understand that XRP doesn't crawl when it moves. It runs fast. That's what makes waves caused by fear of missing out, FOMO. And each time one of these waves grows, it makes the effect of institutional buying stronger. This is where the idea of reflexivity comes in handy. The thought that when prices go up, more people want to buy, which makes prices go up even more. This idea was used by George Soros to explain financial bubbles. And reflexivity isn't just there in crypto, it's the main idea. This vicious cycle can get very bad, as shown by XRP's past. When momentum starts to build, it keeps going until a new price floor is set. Of course, doubters will say that XRP has been overhyped in the past. They will say that there have been years of legal fights, regulatory uncertainty, or adoption delays. But there is one change. Those walls are coming down. The SEC case that XRP was hampered by for years is no longer the main story. Ripple's technology is being tested and used by organizations around the world, and ETFs are moving acceptance from speculation to the core of the financial system. The story has turned around. It's no longer true that XRP is an asset waiting for its chance. On top of that, a pipeline of catalysts is now built on top of it. From the point of view of an investment with the long term, let's take a step back and look at this. Imagine that you are in charge of a fund worth billions of dollars. You see an asset that has a fixed supply, exchange funds that are going down, and real-world use in payments around the world. The Federal Reserve is also lowering interest rates, but inflation is still higher than the goal level, and investors are eager to find new investments. On top of that, regulations are becoming clearer and ETFs are being accepted. Should you wait on the sidelines or rush into the market first to get a good spot before everyone else does? You don't wait if you're smart, you do something. That's exactly what's going on right now, and we know what happens next from history. Everyone thought that XRP would have long-term value, so its 1,600% rise didn't happen in 2017. It happened because of how things work. There is not enough supply to meet the high demand. Fundamentals made things worse. Things work the same way now, but on a much bigger stage. Instead of a few million individual investors, there are now pension funds, hedge funds, and other groups that have to make investments. We don't have exchanges with little or no liquidity. Instead, we have global systems ready to accept trillions of dollars. Not only have we heard rumors about bank pilots, but we have also confirmed acceptance and seen real payment flows. Then what does that mean in real life? For this reason, the math points to a huge rise in value. Even the most optimistic predictions say that XRP could reach $6 soon. But that's not all there is to it. When you think about reflexivity, institutional buying, rate cuts, and ETF flows, it's very likely that the style surge of 2017 will happen again, or even bigger. A $20 XRP is no longer just a pipe dream. This is a possible outcome that is supported by past events, math, and things that are already starting to happen. Also, keep in mind that supply shocks don't happen slowly. They hit hard and fast, giving people who are late almost no time to respond. That's why getting in the right place ahead of time has always been the key to getting asymmetric wins. People who wait for news stories to confirm the move have already missed the boat. When everyone finally wakes up, those who saw the signs first will be in the best position to make money. That's where we are now. The lights are going off and on. There are stacks of triggers. The quantity is going down. The desire is about to come in droves. And we know what happens next when all of these things line up because history tells us so. We've already seen it, and we're about to see it again. But not on a scale that could change what people thought was possible with XRP. At the moment, everyone wants to know how high XRP can really go in this cycle. There is no way to know for sure what will happen, but we can use experience, the way supply works, and the size of institutional demand to get a good idea of what to expect. The answer is that the factors are strong enough to make price action go through the roof. Things that just didn't happen in any other time. Start with what's clear. The story of XRP is old news now. Even in 2017, it was seen as a dangerous experiment and a bet on something that you didn't know much about. In 2021, it was fighting with regulators, and the SEC case was like a storm cloud over its head. The question of adoption was still there, even during the 2024 election term. Now, though, the pieces are not lined up the same way. Regulatory transparency is getting better, payment lanes are getting a lot of use. Of course, institutional vehicles are being allowed for the first time ever, which will allow trillions of dollars in traditional finance to flow into XRP. That last part is very important, because ETFs don't just make things more legitimate, they also change the amount of demand. A wealth advisor in London or a pension fund manager in New York won't open a Binance account to buy XRP. Instead, they will use a known brokerage account to buy ETF shares. That simple change in how easy it is to get to opens up a whole new group of buyers. And each of those shares has to be backed by real XRP bought on the open market. Add the macro background now. The Fed isn't just making one cut. If the job market keeps getting worse and unemployment keeps going up, they might have to cut more than once before the end of the year. With each cut, more cash comes in, more money is put into risky assets with every cut, and every cut makes people want to find other methods that work, assets that can't be changed by the central bank. Crypto is the best way to get rid of it, but this is the part that most people don't think about. When both individuals and businesses buy at the same time, reflexivity has a bigger effect. We saw what happened in 2017 when demand only rose at stores, a 1,600% rise. We saw what happened in 2021 when regular people piled into altcoins while big banks focused on Bitcoin. The parabola moves all over the board. On the other hand, in 2025, both sides will be hitting buy at the same time. Institutions are making sure there is enough supply for ETFs, and individual buyers are buying in quickly because they don't want to miss the next big run. That's the measure of reflexivity. I can't believe the math. Let's say that in the first year, only 1% of the trillions of dollars that BlackRock and Fidelity manage goes into XRP ETFs. There is a need for tens of billions of dollars. And because there isn't a lot of XRP floating around on exchanges, even a small amount of that desire can cause prices to rise dramatically. It's not just how much money comes in, it's also how little you have to spend it on. And there is less availability already. There are first signs of what's to come as exchange funds drop by over 5%. People who own tokens are putting them in cold storage because they don't want to sell them during rises. Supply is being locked up by long-term believers. And when demand goes up, the price goes up because every ticket that is taken out of circulation puts more pressure on it. This is how supply spikes really work. Things look calm until all of a sudden the dam breaks. The story changes right away when that break happens. Suddenly, big news outlets start to talk about XRP's rise. Financial advisors who didn't pay attention have to explain it to their clients. Friends who didn't believe in crypto start calling those who did. That's when the real FOMO stage starts. When people join because they feel social pressure and fear of being left behind, not because they believe in it. Because of this, that point has always been the steepest and fastest part of the drive. How high can XRP get? Already, conservative analysts are asking for $6 in the near future. More optimistic predictions say that $10 to $20 is a reasonable goal for this bull run if a lot of things come together. And those numbers aren't out of the ordinary when you look at past multiples. There have been 10x or even 20x moves before in crypto. It has happened many times when supply spikes happen. The amount of money at stake is different this time. Instead of billions of dollars coming into the digital asset space, trillions of dollars could arrive over the next few years. If even a small amount lands on XRP, it will have a huge effect on the price. This is about more than just price goals, though. It's about the bigger picture. The idea behind XRP has always been that it is a bridge asset that links standard finance to the future of digital payments. For years, that story seemed far away, like it was just around the corner. The bridge is no longer just an idea since ETFs, ODL traffic, and institutional adoption are all coming together. People are walking on it right now. It's different this time because of that. That's why the supply shock is likely, not just possible. Also, keep in mind that XRP has always moved in bursts, with long periods of stability followed by huge gains that change the market cap in weeks. We're now in the pre-burst phase, which includes consolidation, doubt, and building up. It's just the right time, the triggers are stacked, and the pressure is rising. The release will happen quickly, violently, and never be forgotten. Investors will remember this moment for years to come and say, that was the chance. I wish I had set myself up for that loop. A lot of people will miss it after the fact, but the lights are flashing now. History is happening again, this time only, with ETFs, organizations, and widespread use taking it even further than before. The question is easy to understand.